Intuit just changed the game. The company isn't simply adding another AI feature to QuickBooks. It is putting AI directly on top of the financial data that businesses already trust, and that changes the potential of the entire platform. Intuit Intelligence can now help explain what is happening inside a business, identify problems, uncover the reasons behind financial changes, and increasingly help users take action. But the bigger story is not the chatbot. Intuit is using AI to increase the value of its proprietary data, deepen its ecosystem, and move upstream into the mid-market, a market estimated at $89 billion. So the real question is simple: can Intuit turn AI into its next growth engine? For years, QuickBooks has been the system where businesses record what happened financially. Now Intuit is trying to make it the system that helps explain what those numbers mean. Intuit Intelligence Chat connects conversational AI with a company's own financial data, allowing users to ask questions in natural language, analyze performance, identify anomalies, and generate insights without navigating through multiple reports. More importantly, the AI can recommend actions and, with user confirmation, initiate workflows. That changes the role of QuickBooks. It is moving from a system that primarily records financial activity toward a platform that can interpret that activity and help businesses respond. The data was already there. Intuit is now trying to make that data far more valuable. The real change begins when AI moves beyond reporting and starts explaining the numbers. Traditional accounting software can tell a business that revenue fell, margins declined, or expenses increased. But management often needs a more important answer: why did it happen? Intuit Intelligence is designed to analyze financial data, identify anomalies and variances, and help uncover the underlying drivers behind business performance. That can turn financial reporting from a backward-looking exercise into a decision-making tool. For a CFO or business owner, the value is not simply getting another report faster. It is reducing the time between seeing a problem, understanding its cause, and deciding what to do next. That is where Intuit believes AI can create real economic value. The bigger opportunity for Intuit may not be making QuickBooks smarter for the customers it already has. It may be using that intelligence to move those customers into a much larger market. Intuit is expanding QuickBooks Online Advanced and Intuit Enterprise Suite to serve businesses with more complex accounting, reporting, entities, currencies, projects, and workflows. This is a deliberate move upstream into the mid-market, where companies need more sophisticated financial infrastructure but may not want the cost and complexity of traditional enterprise systems. AI strengthens that strategy because it can make a more powerful platform easier to use. Intuit is not simply trying to sell more accounting software. It is trying to capture more of the financial workflow as its customers grow. The scale of the opportunity explains why Intuit is pushing into the mid-market. The company has estimated the opportunity at roughly $89 billion, covering about 1.9 million businesses. But the important question is not whether Intuit can claim that entire market. It clearly cannot. The question is whether its combination of QuickBooks Advanced, Enterprise Suite, AI, and connected financial services can capture a meaningful share of it. Larger businesses require more complex accounting, reporting, and workflow capabilities, creating more opportunities for Intuit to monetize each relationship. The $89 billion figure matters because it shows how much larger the addressable opportunity could become if Intuit successfully moves customers upstream. The important point is that Intuit's mid-market strategy did not begin with this latest AI launch. QuickBooks Online Advanced already had meaningful traction before the newest intelligence expansion. Earlier Intuit disclosures showed advanced subscriptions growing 28%, demonstrating that customers were already moving toward the higher value tier. Meanwhile, Intuit's latest results showed continued strength across its broader online ecosystem and strong momentum in its mid-market business. That distinction matters. AI is not being introduced into a stagnant product. It is being layered onto an existing growth strategy. The opportunity is therefore not simply to create demand for AI, but to use AI to increase the value of a customer base that is already moving toward more sophisticated products. Customer growth is important, but the more powerful opportunity may be what each customer is worth. Intuit's earlier disclosed data showed that QuickBooks Online Advanced generated roughly 5 times the ecosystem ARPC of the rest of its QBO base. That changes the economics of moving businesses up the platform. A customer that adopts Advanced can potentially use more accounting capabilities, payments, payroll, bill pay, business intelligence, and AI-powered services. Each additional service can deepen the relationship and increase monetization. This is why the mid-market strategy matters so much. Intuit does not necessarily need millions of new customers to create meaningful growth. It can also grow by making existing customers substantially more valuable as their businesses become more complex. This is where Intuit's strategy becomes more interesting. Every business using QuickBooks generates financial data, and that data can make Intuit's intelligence more useful. Better insights can help customers automate more work, make faster decisions, and use more of the platform. That creates a potential flywheel. More customers generate more data, better data supports better intelligence, and better intelligence can increase the value of the ecosystem. More value could encourage deeper adoption and stronger retention. The important point is that Intuit does not have to win the AI model race by itself. Its potential advantage is the combination of proprietary financial data, domain expertise, workflows, and a large installed customer base. That combination is harder to replicate. QuickBooks is expanding far beyond traditional accounting. The platform now connects accounting with payments, payroll, bill pay, reporting, business intelligence, and AI-powered workflows. That matters because every additional function increases the amount of business activity flowing through Intuit's ecosystem. More activity can create more data, deeper customer relationships, and additional opportunities to monetize each account. AI potentially accelerates this process by making a broader platform easier to use. The strategic goal, therefore, is not simply to make QuickBooks smarter. It is to make QuickBooks more central to how businesses operate, analyze performance, and make financial decisions. If Intuit succeeds, the platform could become harder to replace, and significantly more valuable per customer. Intuit is not only adding AI to its products. It is also reshaping the organization around a more focused strategy. The company announced a workforce reduction of roughly 17%, with restructuring charges estimated at $300 million to $340 million. Management said the goal is to simplify the organization and become faster, leaner, and more focused. More importantly, Intuit has identified AI-native capabilities and the mid-market as strategic areas for growth. That makes the restructuring more consequential than a simple cost-cutting exercise. The real question is whether resources can be redirected toward higher priority technology and growth initiatives. If Intuit can innovate faster while maintaining growth, the restructuring could become an important part of its AI and mid-market strategy. There is an important gap between having AI and creating economic value from AI. Intuit can add powerful intelligence to QuickBooks, but customers still need to adopt it, use it, and ultimately move toward higher value services. The real test is whether AI changes customer behavior, more upgrades, greater ecosystem adoption, stronger retention, or higher revenue per customer. Competition also remains a factor, because AI capabilities are spreading across accounting and enterprise software. This creates a critical uncertainty for investors. Will AI become a meaningful economic driver, or will it simply become another feature customers expect as part of their subscription? For Intuit, the technology is only the beginning. The economics are what matter. The ultimate test is Intuit Enterprise Suite. The question is no longer whether IES can handle more complex businesses, but whether Intuit can scale it into a meaningful growth engine. The platform now targets companies that need multi-entity accounting, advanced reporting, and broader financial workflows. That gives Intuit a path into the mid-market, but execution will determine the outcome. Investors will ultimately watch customer adoption, revenue growth, retention, and economics. If IES can scale while preserving the simplicity that made QuickBooks successful, Intuit could extend its growth runway. If adoption remains limited, the $89 billion opportunity may remain more potential than reality. The Intuit story is no longer just about making QuickBooks better. The bigger bet is whether Intuit can combine three advantages: A, proprietary financial data, and access to the mid-market. AI can make the company's data more valuable. A broader ecosystem can increase revenue per customer. An enterprise suite can potentially move Intuit into a much larger market. But none of this is guaranteed. The key question is whether these pieces reinforce each other strongly enough to create a durable growth engine. If AI increases engagement, raises ARPC, strengthens retention, and helps IES scale, Intuit could be entering a new phase of growth. The market is ultimately deciding whether that potential becomes economics. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.